I'm CBC money columnist Bruce Sellery. Here is a bit of a riff on the column I delivered to the afternoon drive shows this afternoon, talking about the latest from the Bank of Canada. No surprise on the rate cut. It was a near certainty given the bank's need to cushion the impact of those tariff threats. But the press conference was a bit of a surprise, mostly so boring. This one, probably the most engaging in recent memory. Governor Tiff Macklem and Senior Deputy Governor Carolyn very focused on addressing the questions that affect everyday Canadians and doing so in the simplest possible language. They also released details of their latest survey of businesses and consumers, and it put some data to what we already know. Canadians are really, really concerned, and they are really concerned about job security, in particular in the sectors that may be impacted by the trade war the most: mining, oil and gas, and manufacturing. The bank also noted that Canadians are responding to the threat in terms of increasing savings and lowering discretionary spending. This is good. We don't have our heads in the sand. As always, the bank is keeping a very, very close eye on inflation. It's hovering around 2%, though Macklem predicted it would rise to 2.5% in March as the GST tax break comes to an end. He said they will have to proceed very, very carefully to balance the upward pressure of inflation, because tariffs make stuff more expensive, and the downward pressure of weak demand because of the uncertainty of the trade war. The bank reiterated that Canadians do not want another spout of inflation, and they're going to do whatever they can to avoid that. He made an interesting comment about export numbers. So that number was really strong in the first quarter of this year. Part of that, though, was businesses trying to get ahead of the tariffs and therefore shipping goods early. He noted that that pulls forward sales, right? It doesn't increase them. It's like if you buy a 24-pack of paper towel, the big sale is for the paper company in that quarter, but you're not going to be buying paper towel for 6 months now, so don't get too excited. They also talked about the business sentiment amongst businesses, and it was quite negative. Businesses, 48% of them, at least those surveyed, plan to reduce investment. 40% plan to pull back on hiring. And of course, that is really worrying in terms of the job market. The bank didn't provide a specific forecast on the employment rate, but of course, it is a major, major focus. We've been talking almost exclusively about tariffs from the US, but businesses are also seeing tariffs from other countries like China that are pushing prices higher as they move through the system. One final, less tangible consequence: it is so much harder to negotiate price contracts, because how do you commit to what to charge someone when you really don't know what your cost is going to be? So you kind of have no choice but to increase prices in advance of the tariffs being applied. On the question of a recession, and of course, this is a very big question, the Bank of Canada said that it had no particular forecast on today's decision. What it did say, though, was that in its survey to Canadian households, is that sentiment has turned quite strongly to the negative. People are saving more and spending less, and this, quote, doesn't bode well for growth. Now, the bank went on to say, we are now facing a new crisis. Depending on the extent and duration of the new US tariffs, the economic impact could be severe, and the uncertainty alone is already causing harm. Ugh, not great. I don't like that quote. When asked, the bank said that it didn't seriously consider a rate cut of 50 basis points this time around because it didn't want to get ahead of itself, and that they're going to proceed carefully with any change on rate. On the Canadian dollar, the bank acknowledged the decline. It made an interesting point, though, that the decline can serve as a bit of a shock absorber, helping exporters a little bit because the cost of our goods are cheaper to foreign buyers. The lower dollar and lower interest rates working in the same direction to support the economy. However, cold comfort to you if you're traveling outside Canada, because the lower Canadian dollar, means the loonie just doesn't go as far. What happens next? Predictably, more drama, more tension, more headlines, more trips to Washington, more distraction from all the other things that governments and businesses should be working on. On the interest rate front, Manulife is predicting 3 more cuts in 2025, which is relevant to you if you're in mortgage renewal mode. In the US, the Fed's going to make its rate announcement next week, but no one is expecting a cut there. And Listen, I would just ignore the stock market. I think we need to invest in a low-cost, diversified portfolio and then forget about it. Just don't look at your investment statements because you're not going to like what you see. It's like getting on a scale at the end of December. Just don't do it. The news will not be good. Stay away from the scale.